And as a final way of looking at the scale of what might occur over the coming years, this chart here shows gold's share of investable financial assets. And what you can basically see is that for every $100 that's actually out there in capital markets right now, there's $53 in fixed income. As I say, that's a market with yields at all-time lows and risk at all-time highs, and $37 sitting in the equity markets, which are historically exceptionally expensive at today's value. A little bit of money in money markets and alternatives, and next to nothing in gold. An item that is absolutely fixed in supply. So there are essentially $99 that could rotate towards precious metals in the coming years. Of course, not all of it is going to go there. But even if $5 go there, that'll probably push prices up 4 or 5 times. If 10% of this money finds its way to gold, it'll push prices up easily towards $8,000, $9,000, $10,000. That's the bottom line. Because the supply is fixed, additional demand for the products can only be met at significantly higher prices. Before I finish, I just want to have 1 or 2 quick words on silver. A lot of people ask about silver as well, particularly a lot of younger people. First thing to say is that the historical ratio between gold and silver has been around 20 to 1, sometimes 15 to 1. Currently, it's 60 to 1, meaning you need basically 60 ounces of silver to buy 1 ounce of gold. So if we were to see that ratio narrow, we could expect that silver prices will outperform gold and in percentage terms go up by even further. So if we were to see gold at $3,000 and a 20 to 1 ratio between gold and silver, you'd be talking $150 in the silver price. So a gold investor would basically double their money with a little bit more on top, getting to $3,000. An investor in silver would basically make 6 or 7 times their money. So whilst I think gold should be the core holding for anyone looking to save and preserve wealth in the next 10 years, there is clear upside potential for those of us that are wanting to look at silver as well. And it's obviously a much more affordable investment for people because you can pick it up at 25 bucks an ounce rather than $1,400, $1,500 an ounce. But must be mentioned that the price is significantly more volatile than gold. Where gold has those corrections of 20, 30%, silver can sometimes fall 40 or 50%. And last but by no means least, it is also still a bit of a quasi-industrial metal with production much more correlated to base metals. Silver is not that much of the world's silver that's produced is actually produced as a primary product. It's mostly produced as a byproduct of other mines, people that are mining either for gold or for industrial metals. So it plays a slightly different role to gold, but it is a monetary metal. It is a long-term savings asset as well. And for those of us that can stomach the volatility, it's probably actually going to appreciate in percentage terms by more than gold was, as it has for the last 10 years. And a final thought to share with you guys today before I bring up Roy from First Gold is this comment here from Sir John Templeton, who I think was one of the last century's genuinely great investors, business people, and philanthropists. And he basically said that the 4 most dangerous words in investing are that this time it's different. Now, what you're going to hear a lot, what you've probably heard a lot of in the last few years, and what you're definitely going to hear in the years ahead, is that this time is different and that we can constantly spend money that we don't have. And you're going to hear that this time is different and that despite the fact every other attempt at printing money has led to economic chaos, that this time around it's going to be just fine and that there's nothing to worry about. Reality is that that is very, very unlikely to be the case, and that expression there should just make all of us very, very aware of the risks that are out there, what's really going on in the economy, and the importance of protecting our wealth. It's not always about trying to invest and make the most amount of money possible. Sometimes the smartest thing we can do is just preserve that which we've already got, and whilst other people are losing money and struggling, that can be a really, really powerful thing. Thank you very much. If you guys would like to find out more, please do jump onto our website, www.abcbullion.com.au. We'd love you guys just to sign up to our complimentary education series. I write a lot of market reports, do a few videos as well, so we'd love you guys to receive that. We're having a seminar on September the 12th, so we're actually bringing out a guy called Ronald Stoffele from Europe. He was actually voted the world's 2nd most accurate gold analyst in 2011. He's going to be talking about precious metals as well. I'm actually going to talk about the Aussie economy and what's going on there. We are doing a special offer for unit students or unit members, so we will send you guys all an email with an offer there. And for those of you that are social media savvy, which is you're probably all a lot more social media savvy than I am learning to use Twitter, and you can get me at that address there. So thank you very much, but I want to bring up Roy now as well, because we're going to talk a little bit about First Gold, the product that they have developed, and how it's a fantastic way for people to start their precious metal savings. So Roy, welcome up.
Thank you. Hi guys. So that was, I'm sure you would all agree that was very interesting. There's just a couple of points that I'd like to add to that. Firstly, the real definition of inflation, which according to the Austrian economist definition, is an increase in the monetary supply. So basically the inflation's been done. What we're waiting for now is we're waiting for the effects of the inflation, which is the price inflation, and that's coming. And as Jordan said exactly, the things that you need to live are going up. The things that you don't really need, or the assets that you bought or that have been bought in the good times, that's what's going down. Okay, so basically what we did with First Gold is anyone can go and buy gold, and gold is the ultimate currency. The problem with gold is that gold doesn't circulate, gold and silver. Whatever I say for gold is true for silver as well. Gold and silver don't circulate. So basically what you've got is the only real currency is not actually acting as a currency. So the functions of money have basically been split. What you need to use for transactions is currency, Australian dollars, US dollars, etc. But what you need to use for your savings and for wealth preservation is gold and silver. So what First Gold is it's a new, and for Australia it's new, it's the first one in Australia. That it has been done around the world. It's basically a gold and silver savings plan, and it allows you to split that function of money. So it allows you to use currency for your transactions, but it allows you to transfer some of that currency which you would normally have in your savings account into your First Gold account and save it in actual physical metal. All the savings, all the money that's in your First Gold account is physically backed by metal. So yeah, that's basically it. That's all I wanted to say, but I just want to read you a quote from Ludwig von Mises, who was basically the father of Austrian economics, and this will put things in perspective for you. There is no means of avoiding the final collapse of a boom brought about by a credit expansion, which is basically what we've had. The alternative is only whether the crisis should come sooner as a result of a voluntary abandonment of further credit expansion, or later as the final and total catastrophe of the currency system involved. Now, if you do any research and you look at what's happened with paper currencies that are unbacked, you'll see that all paper currencies, as Voltaire said, collapse. They all collapse in the end. And there's no difference, in my opinion, there's going to be no difference this time. So basically, you're going to be left with whatever gold and silver you've got. And that's it. Thank you.
I think we might open it up to question and answer time.
Yeah.
So if anyone has any questions, please feel free to ask them.
Just a question. At the top of being said around gold that it has no utility and its value is derived from what people discern its value is.
Mhm.
How would you respond to sort of claims that sort of say, well, in bad economic times that yes, people might sort of put their money into gold as sort of safe haven, but that you can't actually get your money back out of gold?
Sure. I guess the answer to that is that this note doesn't have any use either. I can't eat this. I could theoretically set fire to it or something like that to keep me warm for 30 seconds. The point is that money in and of itself is not there as it's not meant to have productive use in and of itself. It's there to facilitate exchange and to store and measure value. And gold, as Roy said before, and as I was saying as well, has always been the best way to preserve value and store wealth. So it's not meant to have use like an industrial commodity does. The other point I'd make to you as well is that this is potentially a little bit philosophical, but for a society to function, or for society as we know it to function, we need to be able to exchange. And to be able to exchange, we need money, right? Money represents 50% of every transaction, right? We buy a coffee, we pay money. We catch a bus, we pay money. We need good money for society to function properly for a long period of time, and the best and ultimately only form of money is gold. So before you can have industrial use for commodities, you actually need a monetary commodity that actually works to preserve value. That's right. Right.
Yeah, for any economic system to actually function properly and for human advancement, what you need a pricing mechanism. And the only honest money is gold and silver. If you've got dishonest money, your pricing mechanism falls apart, especially if you've got government intervention distorting the market. So, I think it was, in fact, I think it was Warren Buffett's father who wrote a paper, said that was something to the effect that human freedom is linked to gold. So it's actually, that's something that maybe you should just look up and have a read of. It's very interesting. But Howard Buffett, it was written by Howard Buffett, completely different to what Warren Buffett would today say, that you can't eat money and you dig it out the ground and you put it in a room and you look at it and then you put it back in the ground and guard it, or whatever he said. But if you read what his father said about gold, you'll actually get the right impression.
Yeah, I think it might be another one that might, building on what Warren's father had to say, is that if I can highly recommend another read for everyone, type in or into your computers Alan Greenspan, Gold and Economic Freedom. Obviously, Greenspan's one of the world's most famous central bankers, but have a quick read of what he wrote back in 1966, an article called Gold and Economic Freedom, which I think you'll find a very good read.
Yeah, that was before he was corrupted.
Yeah, Trojan horse. Please.
Sorry, what would you say, given your expertise in the Australian gold market, three major determinants of current gold prices in Australia?
As in the major reasons for the correction, or just where it is now, or? Three main reasons. Well, I guess the first one would be in terms of what happened back in April. We had sort of a few investment banks go bearish on gold or issue some bearish reports, which led a lot of hedge funds to go short and speculate in the paper market. So to give you guys, I guess, a sense of the scale there, in April when the gold price corrected down to about $1,300, there was more paper gold futures contracts traded in 2 days than the value of all global gold mining production in a year. So pretty unsustainable volume of paper gold sold, which all went on the short side and pushed prices down considerably. Another one that scared people a little bit back then was the idea that Cyprus would need to sell their gold to pay for their debts. Obviously, everyone's forgotten about Cyprus now, but it was pretty big news only a few months ago. That was a complete furphy for two reasons. One, it actually showed how valuable gold is and how integral it is to our system. If you have institutions like the IMF saying, we want your physical gold, not paper currency that you've issued, or not bonds issued by your government as payment, that shows you how valuable gold is. But more importantly, the reality is that if you look as a general rule, in indebted sovereign Western nations, if they were all to go and sell their gold at today's prices, on average, they might cover 2 or 3% of the sovereign debt that they have. So it would be a complete wasted exercise for them to sell their gold as a way of paying their debt. And the third reason, or perhaps one of the other reasons for the correction, was ETF outflows. So obviously, there are exchange-traded funds, which are a way that many investors access the physical gold market, or not the physical gold market, by the way they get exposure to the price of gold. And those have grown in popularity in Western institutional asset management over the last 10 years. And there was a lot of outflows in the first 6 months of this year, people dumping those positions, thinking that the economy is recovering, thinking that the equity market was a safer place to invest. So that led to a lot of nervousness in gold prices as well. But again, if you think of one of the charts that I showed, which showed the sort of $63 in bonds, $37 in equities, and 50 cents in gold, Western financial institutions, by and large, have not really embraced the gold story at all across the last 10 years, which goes to show actually how much upside there is once they all start pretty much being